Welcome back, everyone. In this session, we extend the ideas from the standard supply and demand model and apply them to financial markets. Just as we analyze the goods and services, we now examine how supply and demand determine interest rates, which are crucial for understanding saving, borrowing, investment, and broader macroeconomic behavior. Financial markets act as a bridge between savers and borrowers. Think of these markets as matching people who have extra funds with those who need funds. Savers supply financial capital, mainly money. Borrowers demand financial capital to finance consumption or investment. The interest rate is the price of borrowing and lending. It is the rate of return for savers and the cost for borrowers. For example, in the US in 2015, household firms and institutions saved, about $1.3 trillion. These funds generally flow through banks into loans, investment, or government borrowing. The key idea is that the interest rate plays the same role in financial markets that price plays in goods markets. Let's start with the demand for financial capital, which comes from borrowers. Borrowers include households for mortgage, car loan, student loan, credit cards, and firms for business expansion, constructing plants, purchasing equipment, and R&D, and government issuing treasury bills, bonds, and other debt to finance, public project. The law of demand still applies in financial markets. Specifically, when interest rates are high, borrowing becomes expensive, so quantity demanded for loans decreases. On the other hand, when interest rates are low, borrowing becomes more attractive, so quantity demanded increases. So the demand curve for financial capital slopes downward, just as in the regular supply-demand model. Now we turn to the supply of financial capital, which comes from savers. Suppliers, include the household saving part of their income and businesses reinventing their profits and domestic and foreign investors who put money into U.S. financial markets. Also, the law of supply also, applies here. The specifically the higher interest rate means the higher returns for savings, so savers supply more funds. And on the other hand, the lower interest rate reduce the incentive to saving, and which causes a smaller supply of funds. Therefore, the supply curve of financial capital slopes upward. Just like in the markets for goods and services, financial markets reach equilibrium at the intersection of supply and demand. The vertical axis is the rate of return or interest rate. The horizontal axis is the quantity of financial capital, the amount being borrowed or saved. At equilibrium, the interest rate adjusts so that the quantity supplied by savers equals quantity demanded by borrowers. Here at point E0, the equilibrium interest rate is R0 and the equilibrium quantity of financial capital is Q0. Any deviation from this equilibrium creates a financial pressure that pushes the market back toward balance. Let's apply this to a real-world credit card example using this table. At point E, demand for credit card borrowing equals the supply of funds that lenders are willing to provide. In this example, the equilibrium interest rate is 15%, and the quantity of credit supplied and demanded is $600 million. This equilibrium interest rate becomes the market rate that most borrowers face when using credit cards. Now let's consider what happens when the interest rate is above equilibrium, let's say 21%. At this rate, lenders want to supply $750 million. Borrowers only want $480 million. This creates an excess supply of $270 million and too many lenders chasing too few borrowers. What happens next? Competition among lenders forces them to lower interest rates, moving the market back toward the equilibrium, 15%. Now imagine that the interest rate is 13%, which is below equilibrium. At this rate, the lenders are willing to supply only $510 million. Borrowers want $700 million. This creates an excess demand of $190 million. When too many borrowers compete for limited funds, lenders react by raising the interest rate, again pushing the market back toward equilibrium. The same principles of curve shifting can be applied in financial markets. A shift in demand occurs when factors like business confidence, consumer optimism, or government fiscal needs change. And a shift in supply occurs when saving behavior, foreign investment, or economic uncertainty changes. A rightward shift means more demand or more supply, and a leftward shift means less. Here's a concrete example involving US government debt. If foreign investors become less enthusiastic about investing in US Treasury securities, the supply of financial capital decreases. In the graph, the supply curve shifts left from S0 to S1. The new equilibrium moves from E0 to E1. This leads to higher interest rate, R1, and lower quantity of financial investment, Q1. Economically, this means borrowing becomes more expensive for US government and potentially for households and businesses because foreign capital inflows have decreased. Thank you for your attention.